2022. Question number 2, boy. All right, so all of them have already gotten this question. Question 2, boy. So we are told there, the following information is provided on market risk-free rate and the two stocks A and B. So I can see the treasury bill rate. I can see S&P 500 index. We have stocks A, stocks B. So they want me to draw the capital market line. So they want me to draw the capital market line. Draw the capital market line. Draw the capital market line. So if you remember very well, the capital market line is the same as what here, somebody the portfolio. Who is the forgotten? Portfolio equation line, isn't it? The portfolio equation line, if you can recall very, very well, ladies and gentlemen, you can remember the formula. We are saying that CML returns equals who? We start with risk-free, isn't it? So we have here risk-free, plus returns of the market, isn't it? Minus risk-free, multiplied by who? The standard deviations, isn't it? To be specific, standard deviation of the, all of a standard deviation of what here, somebody? The market like that. When they tell you to draw a CML line, please listen and listen to me very well. When they tell you to draw a CML line, they want you to have returns on the y-axis, and then here, what we call on the x-axis, the total risk like that. Whenever they tell us to draw a CML equation, they want us to have returns. Remember the formula. We normally say, if you remember very well, we normally say y equals a plus who? Bx like that. So y are the returns, and then x will be the total risk, the standard water deviation. So that is what you're supposed to know. So what you're supposed to do, come here pretty fast. Even if you understand in this case here nothing about this, we are doing a CML graph. Write the title, underline nicely. Yeah, yes. Is that a question? Yep. Okay. Okay. Let's continue. I'll be able to see the question in a few minutes. Which question? They must have forgotten. Question, normally, we write the question here. December 20, It is December what? 2022. Okay. So December 2022, we forgot that. December 2022. Question number 2B, eh? 2, we start with B first, and then we do A later, right? Thank you for that. So CML graph. So of course we shall have here, we have the returns on the y-axis, and then on the x-axis, what do we have here? Risk. To show the examiner you know what you're talking about, call it total risk. Because CML is about total risk, and then CAPM is about beta. All right, total risk. And total risk is normally measured using standard water deviation like that. Now, please listen, and listen to me very well. I would want you to listen and listen to me very well. We are going to draw a straight line. How many points do we need to be able to draw a straight line? 2 points. So we need 2 points to draw a straight line. To draw, I don't know where you write this, to draw a linear function. A linear function, comma, we need 2 points. And these 2 points are, number 1, we have the risk-free rate point. Risk-free rate point. So in this question, are you able to see the risk-free rate point? Remember, point is normally given by x, y, x, y. So in this case, are you able to see the risk-free rate? Treasury bills are risk-free instruments, isn't it? So you are seeing the treasury bill rate. I can see treasury bill rate. The standard deviation is who? You know, it's x, y. And you have told me x is standard deviation. Y is what here somebody returns. So then are you able to see the standard deviation for treasury bill rate? The standard deviation is 0 because the risk is 0. Then comma, are you able to see the returns of this risk-free rate? Leo si kawaida. Leo ni kama mmechoka sana badilisha lobaka. T-bill, the return is 4, isn't it? So that is point number 1. Remember, a point on a Cartesian plane will be given by x, y coordinate. Those two now we have. And then number 2, we need the market portfolio. We need the market portfolio. So in most of the cases, they will tell us that the market is a Nairobi Stock Exchange. But at times, in this case, they want to show whether you guys are also well accustomed with the international financial news. The Standard and Poor 500 index is a market index. The S&P, this S&P is a market index, international market index, S&P index. So now they want to really pin you down. Yeah, so very few students in that semester were able to understand that S&P is just like the Nairobi Stock Exchange 20 index, 500 index like that. So this S&P, in terms of X and Y, are you able to give me the values there? In terms of X and Y for S&P? 11, 15, Wrong. 15, 11. Because it is X, Y, isn't it? 15, 11. So then I would want you, great students of mine, to go ahead and draw these points here. I can see X, we have a 0. Let's draw these points. I'm so sure you guys will be able to help Mwalimu. Yeah. So then what I'll do if I'm the one doing this, I'll come to my graph. So remember, this is the y-axis. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9. 1, 2, 3, 4, 5, 6, 7, whatever. So I can see some figure there at 15, other figure at 20. Let's do in this case here 2 at a time. So 2, 4, 6, 8, 10, 12, 14, 16. 16. Yeah, for Y return, I'm okay. For Y return, I'm okay. These ones ensure they're a bit smaller because I can see that it's a 25 standard deviation somewhere. We need like 13 boxes. So 2, 4, 6, 8, 10, 12, 14, 16, 18, 20, 22, 24, and then 26 like that. Why am I going up 26? Because when you look at standard deviations, there is one of the points there, which you don't need right now, but one of the points that is at 20, what here, 25. But first, you want to draw those 2 points alone. To draw a CML, you only need 2 points. And those points, ladies and gentlemen, will be, number 1, we have what here? The risk-free point and the market point. Abracadabra, could you kindly map the 2 points yourselves? Ourselves, we are mapping out the 2 points. Let's see what you guys will be able to get there. Let's see what you guys will be able to get there. Remember, this is a 0, basically. That's a 0 there. So when you look at the points you gentlemen and ladies have given me here, the first point is the risk-free point where X is 0 and Y is 4. So X is 0 here and Y is 4 there. You put a mark. Put a mark like that, where X is 0 and then Y is 4. The other point we are told, my great friend, that the other point, which is the market portfolio point, X is 15 and y is 11. So go to the x where x is 15. Where x is 15, you see 15 will be in between here. That's 15. Yeah, you go up like that. And then we have y being 11, like that. You put what here? You put a mark. You put a mark. And then my very good students, of course, now the 2 points given here, I should be able to join them using a ruler, isn't it? You join them using a straight line. Make sure that your line is straight than mine. Mine is not very straight. Straight. Ooh. No, that's very far. I'll give it a second shot before I know how I will cook things. A much better. Yes, much better. So this is what we call the CML equation. The CML equation. This is what we call the CML equation. The CML equation, that is capital market line equation. It's a straight line with a gradient. It's a straight line with a gradient. But we answered the question really fully. They wanted us to draw the capital market line. So now that we have done. In an exam situation, would have you gotten all the marks here? Or rather, the better question should be, should they give us this kind of a question in August? Will you be able to get the marks now? Or then number 2, they want me to calculate. They want me to calculate the betas of stock A and stock B. I don't want to do that. I want to skip everything and go to Roman 4, where they want me to plot the stocks of A and the stocks of B relative to the CML and the comment. Let's just finish with this graph once and for all. So they want me to plot A. They want me to plot A on this graph. What does A talk about? Are you able to give me A in the form of X, Y? Abracadabra. A in the form of X, Y. So A, I'm told, is 25 and what here? 14. Remember, X is standard deviation, 25 and 14. So X axis 25, I can see 25 is around here. Yeah, versus 14. I will have to extend my CML. Yeah, versus 14. So US, of course, is to a better scale. Are you getting your point in this case here being on top of the CML or below? I don't know. Mine I can see. I don't want to. Is it here? Is the point here? Is the point here 1 or down here 2? Is it at 1 or 2? Ooh, let me hear from my online students. Let me hear from my online students whether this point is. Is it below the line or above the line? Don't talk to me if you have not used a ruler, because you'll be cheating me. You'll be cheating me. That one, you will be cheating me. I'm 100% sure you'll be cheating me. That one, you will be cheating me. That one will be cheating me. So below the line or above the line? Below the line. So I'm being told, Mwalimu. So the online students have not answered my question. Above, eh? No, mine is above because mine is not to scale. Mine is not to scale. So the online students here, please talk to me. The online students, please talk to me. Is it below or? Just a minute. Let me get our class. I want to get our class. Watu wanasema namna gani? Below. Watu wanasema aje ndio nipoji yangu. Online wanasema below So online wanasema ati ni below. So 25 online wanasema ni below So below. So what niseme hapa. So it is 11, right? 14 I mean. So what nitengeneze nifanye ukarabati. Kama ule engineer ukarabati sasa. Kwamba this is A. So A is below the CML, isn't it? And if it's below the CML, is it super efficient or inefficient? Inefficient, So A is inefficient because it is below the CML. It is below the CML. So A is inefficient because it is below the CML line. So it's a security I would want to run away from. It's not able to go through the hurdle rate. So A gone. From there, ladies and gentlemen, we look for boy. So boy, where do we have boy? Boy, they have given us, ladies and gentlemen, boy, they have given us. If you're keen, boy will be 20 verses 9. Boy is 20 verses 9. So boy 20 here, X verses 9. I trust it's above. Inafanya ukarabati pia sababu sina, lakini I trust boy is above. Siwafiti inafanya ukarabati. But you guys are okay because you're using squared books. You're using graphs. Some of you should be able to get yours much better than what I have. B is also below. Kuna hiyo kitu yenu ni mbaya hiyo. Lazima moja iko above. Hakuna moja iko above. None. Ui. So I'm being told also B is below. B is below. And this B, they are telling me it is B, it is 20 verses 9. So B is 20. I'll be able to give you a shortcut. 20 verses 9. So it is below here. So again, from this assessment, they are telling me that Mwalimu B is below the line, and therefore it is what here inefficient. B is below the line, and therefore it is what here somebody? It is inefficient, and therefore it is inefficient. Is that okay? I'm so sure there must be those ones who have done exactly what Mwalimu had done, which is cooking things, isn't it? Cooking things. Thank you so much. So I want to see whether we are correct or wrong. So now I want us to skip everything. I want us now to concentrate here and do what is objective, what all of us will be able to substantiate. So I would want at this juncture, everybody to calculate the CML returns of A and B. Of A and B. Let's see whether we have any student who will be able to remember, first of all, the formula of getting CML returns. CML returns. Let's see whether we have any student who will be able to get the CML returns. How do they get the CML returns, and yet some of them have forgotten the formula? Utaona kaninja kamoja kakisema pita mahali, utaona tu. Na hii sio kapea mizidi. Hata mwana anasema pita mahali amejaribu. Wengi hawezi atakumbuka kwamba tunaanza na risk free. We shall overcome. Online guys, have they been able to write the formula? Online guys, have they been able to write the formula? Oi, Yamalo. Thank you so much, Kenneth. Kenneth is telling me, Mwalimu, remember in the capital market, we must always start with risk-free securities. And that is why I was really scared in our last class when you told me that some of you here don't have government bonds in their investments. You don't have any treasury bills. You've never gone to central bank. We shall overcome. We shall overcome. So in this case here, CML returns, we must always start with risk-free. Plus returns of the market minus who? Risk-free. So remember, these are the risky investments. We must always attach the risk factors. And the risk factors are two. We have standard deviation of the security, all over the standard deviation of what here somebody? The market. So could you be kind enough and give me the CML returns for A? CML returns for A. So for you to do that, first of all, you must give me the risk-free. Risk-free rate, anybody who is able to read 4. Plus, do we have returns of the market? Return of S and P. 11. I'm being told it's 11. Minus risk-free, which is 4, isn't it? Can somebody give me the figure to write here for this, for this, for this? What do I write on top for this? The standard deviation of security A. From the table, you're able to see that standard deviation of security A. Unasema 25. So I write 25 over standard deviation of the market, which is S&P 15. 15. So is there somebody who can easily give me this figure? Everybody is punching these figures in their calculator. 15.67. I haven't heard from my online students. I haven't heard from my online students. Why 11, Mr. Joy? We are told here, you can see S&P 500 index, the return there is 11. Expected return there is 11. Lucy Joy, are you able to see 11? And the S&P 500 index, which is our market, just like the Nairobi Stock Exchange Index. Yeah, that's where we got the 11 from. So is everybody really able to get this 15.67? Is everybody able to get? Not many students online are talking to me today. Not many. Why not? Stop. Ryle, you're confusing. Remember here, we are looking for what here? This is returns of the market, the benchmark, which will be applied for all the security. We can't pick the one of A because the one of A we shall be using it to get efficiency levels. So is this 15.67 correct? Thank you so much. I can see Marco confirming there. I hope Ryle has been able to. Yeah. So then could you be kind enough? Could you be kind enough and give me the CML returns of boy? Returns of boy. So remember, this will be 4. Returns of the market will still remain at 11. 11 minus 4, isn't it? Times. Are you able to see the standard deviation of boy? Ngapi somebody? 20 over 15. In about 15 at Chini, isn't it? Yes. Which then will give me what answer? 10 points. 13.3. 33. Thank you so much. Let me see. At least 3 of my online students have gotten 13.33, but that is scaring out of 60 students, honestly. That means I'm not a very good teacher. I'm not able to work with all of you in this journey, which is so sad, but we shall overcome. I shall improve. Yeah. So from here, how will I know that these are points of CML? Okay, I'll be able to explain. So then, having gotten these CML returns, what do you think will be the next thing? In most cases, when you get CML returns, the next thing will be efficiency levels, the profitability levels. You need to come and give us what we call the alpha what here? Returns. The alpha of the security. Is there somebody who remembers the formula? Anybody who is able to remember the formula here? Yeah. So in this case here, this will be expected return of the security minus who? Minus the CML returns. Thank you. So I want to know whether A is profit-making or loss-making. Let me give you a minute. Let me give you a minute. Is A profit-making or loss-making? Valerie, I've seen your question. I'll be able to address your question in a few minutes. The physical students, there is one thing you don't know, all of you, that your greatest strength when you do your SWOT analysis is having a neighbor sitting next to you. Don't take that for granted. Having a neighbor sitting next to you is a big, big blessing. Big blessing, trust you me. You're okay? Very good. It's loss making, eh? You're sure? Ooh. So alpha of A. What is the expected return of A, Ryle? Negative 14. Return of A. Yes, 14, yes. Or some answer, eh? Minus CML return of 15.6, which gives us what here, somebody? Negative 1.67. So meaning because of negative, what name do we give it? Inefficient. Or under? No, over value here. So is this answer consistent with what we got from the graph? Because graph we got it, eh? below. So assuming, for example, when you are drawing this graph in an exam, you drew quite a bad graph, like now what I have here, which was showing me that my A was what here? Huh? Above, isn't it? So it was showing me it was above, and the equation down there, it shows me it's a loss making. I should get my rubber and then fix it where? Because the examiner will not pick a ruler to start and mean. So you need to know how to also engineer things, isn't it? I don't know whether they are able to get that trick, because I've marked these papers for long. In an exam situation, when you are shaking your hands as you're drawing this, chances are you will get these points in a very opposite way. So when you come and get that they are loss making, then you'll be able to come and plot them where? Down here. When they are loss making, it means they're inefficient. So they should be below the line. So you fluke it, say it's down there, you pass. The end justifies the means. So, but for B, are you sure that also B is loss making? So alpha of boy, I should take something minus something. 9 minus 13.33, which then will end up giving me what here? Number negative 4.33. So inefficient, and therefore the two of them are supposed to be below the CML. So you guys are very bright. Your hands are not shaking as you draw your graphs. Very good. There is nobody in this case here who takes anything which is bitter than water, which is very, very good, isn't it? Yeah, very good. So then there we are okay. There we are okay. There is a sister was asked here, how will I know that the points of DCML are these two? Valerie, that one you have to cram. To be able to draw, ladies and gentlemen, a point on a Cartesian plane like this Cartesian plane, I would want a starting point that must be given, which is risk-free. I must always start from risk-free here, and then I go all the way to the what here, to the mark. So risk-free has to be given, market portfolio has to be given for us to be able to draw a CML or even a CAPM equation. So you see, I haven't answered. I was doing part 1. I've done part 1. I've also done part what here, part 4. Even 3 I've done. But see, there was one problem, and they were able to assist students there. See, there was one problem. Let's get, first of all, to address the problem in 3. Let's do problem 2. Let's do question 2, Roman 2, where they want us to calculate the beta of stocks A and stocks B. Beta of stocks A and stocks B. I will give you how many minutes? We should start waiting for you, Mary. But if you promise us, you will be arriving, say, just 10 minutes late. Oh, that's crazy. That is crazy. So I'm waiting for that student who will be able to give me the beta for A and the beta for B. Finished? No, you're doing the right thing. You're making reference, which is good. Yeah. Very good. Very good. Which is really, really. I will not be able to say anything there until I see whether there is a student who will be able to get something there. So please listen and listen to me very well. These beta calculations is one area you will not miss in your exams, beta. There is nobody, let me tell you something. These old exams, we used to provide the beta values. But you say, I told you, I mean, you and your examiner, are you best of friends? No, this is a tug of war. This is wrestling. Yeah, and wrestling. And then, of course, you appreciate the fact that in most of the cases, the examiner can be the bigger wrestler, right? Like your consumer, isn't it? So in this case here, beta factor, first of all, what is beta? It's a measure of what here, systematic risk. Tell us there that, please label your answers very well. Roman 2, beta is a measure of systematic risk. Systematic risk is the risk that is uniformly distributed in an economy. i.e., it is the unavoidable risk. It is the unavoidable. It is the unavoidable risk. It is available in each sector of the economy. You can't say that you can run away from what we are calling systemized or systematic what here risk. It cannot be eliminated. It cannot be reduced. I hope you have written that. Systematic risk cannot be eliminated by investors. It cannot be reduced by those investors. It is in the system. A very good example will be what here somebody in inflation. You can't divest inflation. That are now going to an industry which I will not find inflation. Inflation is everywhere. Ladies and gentlemen, if, for example, we were to have war in Kenya, there is no sector that cannot be, there is no sector which will be spared. War will affect everything. Ebola affect everything, isn't it? ETC. So those are unavoidable. You cannot run away from them. You can't run away from them. If you remember very well, allow me to do something here. There are two types of risks which you must be able to really be good at. You must be good at these two risks. Yeah. So we have in this case here, these are a number of securities. The number of your assets, the number of your investments. And then we have your risk up here. We have our risk up there. All right. Then I would want, ladies and gentlemen, to come here. Yeah. Draw that. So we have two risks. We have A, and then we have this component called B. So between A and B, from your own understanding, which one do you think will be the systematic risk? Which one do you think will be systematic risk? B, because you can see B is uniform. So B is systematic risk. Systematic risk. And this is normally what is measured by beta who? It's normally what is measured by beta factor. It's normally the one that is measured by beta factor. Beta factor. So then A, you can see A is reducing. As the number of securities grow, A is going down. So this A is what we call an systematic risk. Good example being what here? The Forex risk. Forex is foreign what year? Exchange. So you see now, this unsystematic risk, you can reduce it, you can eliminate it. So by avoiding those companies that have it, if, for example, you want to avoid foreign exchange, avoid importing companies. Avoid companies who are doing what exporting. Companies handling foreign currencies and come and invest in RCM. Because RCM, do you ever handle the dollar? No. All our students are paying us in Kenya shillings. When we are paying our teachers it in Kenya shillings. So then you can easily eliminate or avoid unsystematic risks by avoiding those companies which experience those specific risks like that. Now, ladies and gentlemen, I would want to bring this really to your attention. Anytime they want us to give them formula for this beta, because this is very, very important, to get beta of any security, you take covariance with market. Covariance with market all over variance, all over market variance. This is how we get, ladies and gentlemen, the bigger formula for getting what we call beta of a security, beta of a portfolio. So it is covariance with market, all over market what year van? Mwalimu, can you simplify this for us? To simplify this for you, BS will be the covariance between S and who? The market. S and the market, all over the variance of the market, which is standard deviation done what year? Squared. If I were you, I would write this formula and block it and then ensure that I'm highlighting it. Use the color, a nice color. Yeah. Beta of a security is covariance between the security and the market all over the variance of the market, like that. You see, standard deviation squared is variance. Standard deviation squared is variance. So this is what we call the covariance approach. The covariance approach. But you see, your examiner is normally very, very bright. He knows you can easily cram this formula, so he'll not give you covariance. Like in this question, he has not given us covariance. He has given us correlation. So in this case here, then what is the correlation approach? You'll be able to cram. I'll show you. This should not worry you. This should be amongst your list of worries on earth, because I'll be able to show you how to cram these formulas. So correlation approach. So this correlation approach, I would want first of all to throw each one of you to the deep end, and I'm so sure everybody here is a good swimmer. Do we have somebody who does not swim totally? Sure. Like you fear water. You know how to swim, but you don't. Okay. Now, so then into the deep end, would you kindly give me the correlation formula between S and M? That one, I'm so sure we have encountered it. So you are right at the very shallow end, Yeah. Very shallow end. You don't need to be an expert swimmer, because if you remember very well, without you getting into the trouble of checking your notes, correlation is the standardized covariance. So you need to come and take the covariance between S and M. You divide this by the respective what your standard deviations. So anytime you want to get correlation, standardized covariance. Take covariance, you divide by the respective standard deviations to standardize it. So please remember, we said this R is supposed to be a normal R. Don't try to make your R like mine. It's my handwriting, which is poor, and there is nothing I can do about it. So then could you kindly do me a favor, make covariance between S and M the subject of the formula? make covariance the subject of the formula. Make covariance the subject of the formula. What a phobia, I know. If you have that phobia, don't try. Don't try. So make covariance the subject of the formula. If I try cross multiply, you will see that covariance between SM will be RSM, standard deviation of S, standard deviation of who? The market. No, there is one thing that I know you guys have forgotten. One thing. There is a formula that I gave you up there, which you were even able to, highlight. Looking at me straight into my eyes. My brother, look at me. What is this formula? VS should be equal to what? It's covariance approach. So I should take the variance with the market, which is not the variance, covariance. So covariance between what here, somebody? SM. You divide this by what here, somebody? Variance of the market. Can you kindly replace this here? So instead of saying covariance, you put what here, somebody? You put this. Therefore, BS will be equal to RSM, standard deviation S, standard deviation M. And then do me a favor. Are you guys aware that the standard deviation market squared is the same as standard deviation market times standard deviation market? Will that be the same? Yeah. Standard deviation market squared is the same as standard deviation of market times standard deviation of market. Meaning that this market and this market will cancel out. This market here and this market will cancel out comfortably, leaving me with a very, very important formula. Leaving me with a very, very important formula that BS will be equal to RSM, standard deviation S. All over standard deviation of what here, somebody? A market. Nobody will ever want you to derive these formulas. But unfortunately, you will be required to cram them. You'll be required to cram them. And that is why I want us to do a summary. You'll be required to cram them. And that is why we have to do a summary. And I can see it is exactly 6:50. Let's stop there for a few minutes to give our brothers and their sisters from the Muslim faith a few minutes to pray. And then, of course, you can use those minutes if you're not going to pray to cram the two formulas. Covariance approach, correlation approach. Covariance approach, correlation approach. Covariance approach, correlation approach. Sorry. Covariance approach and correlation approach. So those of us who are not going to pray, are you able to use this opportunity to even write down a summary of the BS covariance, BS correlation approach? Very, very important. Very, very important. Because I've told you, we check the most recent questions. How can this examiner give you these beta factors and they want you to fail? They want you to fail. But we shall not fail, because us, we shall keep on revisiting these formulas. So, okay. I think now the 10 minutes are over and we should be able to continue. I hope our Muslim brothers and sisters are now back. I hope they are back. Are they back? Are they back? Are they back already? They are back. Thank you so much. Thank you so much. All right. So summary. That beta of the security, number one, covariance approach, will be covariance with the market That one stops there. You don't bring in the standard deviation for variance with the market all over the standard deviation of the market down what here square. And then on number 2, we have here BS. The correlation approach, you have to be careful. It is R between SM. So this R between SM, R, I have to quantify it further by bringing in the standard deviation of S all over. In this case, then we don't square the market. We don't square the market. So this is what we call covariance approach. And then we have correlation approach. Correlation approach. So in this very question that we are doing of December 2022, question number 2B, which approach do you think are we supposed to be using? Correlation, because the examiner has given us correlation coefficients. Yes. The examiner has given us. So for this question, yeah, correlation coefficients are provided. So use correlation approach. Use correlation approach. Use correlation approach. Use correlation approach. So then, are you able to write the formula and kindly give me the beta factors? Are you able to write the formulas kindly and again give me the beta factors? So you're using correlation approach. I would want to repeat these formulas many times. So we know that beta of a security correlation is RSM, standard deviation S, all over standard deviation M. So in that case, then what is the RSM? 0.7. Do we have the standard deviation of the security itself, A? I should have written it Qn.2 up and BA. So RSM is 0.7 times standard deviation of A, which is 25. All over standard deviation of the market, which is what here? 15. Which ended up giving you guys what here? 1.17. Then get ahead and give me beta B. Are you able to see the correlation of B with the market? What do we have there? 0.5. 0.4. How about the standard deviation of boy of the market remains, isn't it? Which gives you what here, somebody? 0.5. If you are the examiner here, after the students have been able to get beta values, what would you have asked them to calculate next? CAPM returns, yes. Can you kindly go ahead and calculate those CAPM returns now? Now you're becoming an examiner. Go ahead and compute the CAPM returns, not us, but we're just trying to diversify our knowledge, because for sure, when your examiner tells you to calculate beta, the next thing we'd want you to do is to calculate CAPM. Capital assets, pricing, model. Capital assets, pricing, model. Ooh, great. You guys are doing this very nicely. You're saying here that CAPM returns, we must always start with who? Risk-free. So risk-free plus returns of the market minus risk-free. This time round multiplied by what here? Beta. Can I ask you a simple question before I continue? You see, like, for example, in the total risk, we had here something down. It was standard deviation of S. over standard deviation of the market. Because this equation is a replica of the other one, why don't we have beta market here? Beta market is always equal to 1. Beta market is always equal to 1. And I know how this examiner will trick you, and I'll be able to show you the question of that nature. This guy will give you 3 securities. Then will give you, like now, let me just show you something here. This is what this gentleman will do. Don't write this. This is what he will do. So he'll come and give you betas here. He'll give you returns here. So he'll tell you 0.71, 0.8. So this is 4, 5, and 9. Then we'll come and give you risk-free. Is 3%. Risk-free is 3%. All right. Now, when you are given something of this nature, and then they come and ask you here, don't write this. Or if you are writing, you can only write it at the back of your books. Then they come and ask you to provide AFM returns. You'll get so many guys coming back to me telling me, Mwalimu, that question had an error. But of course, you being great people, you can't get out of this exam with nothing. You'll come and don't write this. If you're writing, it has to be at the back of your books. So you'll come and write the formula first. You will say AFM returns equals what? Risk-free plus RM minus beta, isn't it? Of the security. So like if I want to get AFM for A, AFM returns for A, are you able to see the risk-free? 3 plus, what is the returns of the market here? Huh? 4. No. You want returns of the market, and the market portfolio is known in advance and will remain constant. That return will remain constant. So it cannot be for security A. RM is normally the same throughout for all the security. They have just forgotten, and I knew if I was an examiner, I would have taught them live. Beta of the market is always equal to 1. You see these betas? Whenever you see any security having a beta factor of 1, then that is a market security. This one here is a market security. And if it's a market security, then are you able to see RM? RM ni ngapi? Niko peke yangu. 5 years. RM is 5. You unajua tamjaelewa bado shalom kama. What have we just said somewhere up there? That the beta of the market is always equal to what here? So you can easily use this beta as here to evaluate among the 3 securities, which one is a market security. The market security will always be the one whose beta is 1. The one whose beta is 1. How I wish like the physical guys here were great at discussions and they were seated next to somebody who knows their mother tongue. I would have wanted them to take like a minute to talk about this in their mother tongue. In their mother tongue. Do you know some Kikuyu? Not at all. Aya. Nasema unajua kabila. Unajua kabila. Mimi najua hata ile huwezi kuwa najua. Ya ndani kabisa hizi. So ukipatana na mama kama unatoka Nyeri na huyu mama ni kama Afrika mamako. Unamwambia waki ama ito hizi. Yeye anasema namna gani? We shall overcome. Don't worry. So then this one, you can see for A, the RM in this case here said is 5, isn't it? Risk-free is 3. And then you can see beta of A now, which is what? Yes, number 0.7. We shall come back to this. I told you not to write this. I just wanted to show you some trick. There. So then are you able to give me these AFM returns really for the 2 securities here, A and B? Great. So that is your assignment, and ensure that you really complete that. Because now you are experts, better experts. You guys are experts. So that question, I would want you to go and revisit it. It is really important. Now, the other thing which I would want us to learn today is in the August 2022 question number 5. August 2022 question number 5. August 2022, question number 4. So August 2022, question number 5, if we are there, my friends, this is about optimal weights. Optimal weight or proportions. Optimal weights or what we call proportions. I'll come back to part A, the one asking about assumptions. I'll be able to address them today. But before I lose my energy, let me do this concept of what here, optimal proportions, which is really important. Now, my very good students, if you get this kind of a question, what are you supposed to know? You know, you'll be told that you've got like Kenya shillings, what here, 3 million. And then we have two securities. That is A and what here, somebody, A and B. Then we'll be asked, what percentage should be invested in A and what percentage should be invested in B? For you to optimize your returns. For you to optimize your returns. There is a formula again. There are so many formulas here. Fortunately, we are now at the tail end of this topic. So to get the optimal weight, what I will call like weight of A, we use variances covariance approach. So to get weight of A, we shall take the variance of B. You take variance of the other security. So because there are only two, you take variance of B minus covariance of AB. All over variance of A plus variance of B, because now there are two variances, you have to double your covariance between AB, so it becomes 2 covariance AB. This is a very, very important formula for getting the weights. That one. So remember, W stands for what here? Weights. Weight A, like that. I told you, cramming of the formulas, that should not scare you. That is my assignment. Even if it means we come here one Sunday to simply cram and master all the formulas, I'm willing to do that. For now, just try to understand how to plug in the numbers. That will really be the very, very best. So then, these optimal weights, I hope they have been able to write the formula. We are given this question of delta and who? And alpha. Are you able to see that? So we have here probability 0.2 from the past paper, right? August 2022 question 5. 0.25, 0.25. It's a different question. Irrigation kit equal near wapi. An investor has decided to invest 2 million in the shares of 2 companies. It's not August. Woi, wanasema aje hawa? Wanasema maybe wanajua swali wameiona, basi iko mahali hapo tu. Ni 1B. Same city. Oh, question 1B. Thank you so much. Thank you so much for saving me. Yeah. August 2022, question number 1B. The question of optimal weights. Question of optimal weights. So I will read together. An investor has decided to invest 2 million in the shares of 2 companies, namely Dela and Alpha Limited. The projections of returns from the shares of the 2 companies, along with the associated probabilities, are as follows. So you can see their probability from Dela and probabilities, returns from Dela, and then we have returns from who? Alpha. They want me to determine the proportion of each of the above shares required to formulate a minimum risk portfolio. So we don't know out of the 2 million, what percentage should go to delta, what percentage should go to alpha. So they want me to get optimal weights. Optimal weights. So what should be the first thing that I should do? Actually, you are even right. I think the combo. Watch and part opportunity ya grab answer from scratch. Very good. So you come, ladies and gentlemen. Now in this case here, we have our probability. We have our probability. Yes. So probability, we have 0.2, we have 0.25, we have 0.25 again, we have 0.3. Then we have returns of D in percentage. Do you know what is D? Delta. And then we have returns of who? A. Again in the form of what your percentage. So returns of delta, we have 6, 7, minus 3.5, then we have 14. Alpha, we have 8, 5, 14, and -1. This is really interesting. Really interesting. Very interesting. Now, ladies and gentlemen, let me give you a secret in FM. When you see probabilities and returns, even if you know nothing about what is going on, what should you always do? Multiply them. Yes, it's a trick. You need to understand here. So basically, come and give me RD times probabilities. That's RD times, and then you give me RA times who? Probabilities. So in short, incorporate risk factors into the returns. Incorporate risk factors into the returns, because like when we get these 6, I mean, with the probability, it cannot be 6. So RD times probability, RA times probability. So I would want you to aggressively give me the RD times probability without getting it wrong at all. So probabilities are shared, right? So 0.2 times 6 gives me what? I would also want to hear from my online students, for sure. For sure. So what do we have there, ladies and gentlemen? So I'm doing RD times probability. The first one is nimewacha wanafunzi online nyuma. Wanafunzi online wamebaki nyuma oye. At least Patricia has given me a figure of 1.2. And then the second one is 0.25 times 7, which gives me 0. No, 1.75. Thank you so much. Minus 0.2, or rather, 0.25 times minus 3, minus 3.5. Negative 0.875. 0.3 times 14. 4.2. After you do these RDs times probabilities, what should you do next? You sum them. You sum them. And whatever answer you will get will be called expected return of D. Whatever answer you get will be called, thank you so much, online now, students, you're doing a great job. You're doing a great job. So come and sum RD times probability, sum expected returns of D. We're summing everything. 1.2 plus 1.75 plus minus 0.875 plus 4.2. I'm being given a figure of 6.275. Then we go to RA times probability. 8 times 0.2 or 0.2 times 8. Thank you so much. The first one I'm being told is 1.6. So now I'm taking these probabilities again, but now times returns of A. Thank you, Pauline. John Baraka has confirmed. Next one is 1.25. That is 0.25 times 5. 0.25 times 14? 3.5. Then we have 0.3 times minus 1. Please add them And whatever you'll get now, it's an expectation. 6.0, you double on a line to confuse the examiner. The examiner will think that this student has done a lot of work. Very good. Very good. Now, my very good students, after I've done that, now I've been able to get what we call the means. In the statistics, when you get a mean, the next thing should be deviation. Yeah, so we need the standard deviations. We need the variances. So the next step, ladies and gentlemen, that I would expect you to go and give us their priority first. Mention there. I don't know whether somebody will be able to remember the formula here. Yeah, give me step number 2. Give me the variance of delta. Variance of delta. First of all, do you remember the symbol? The symbol is like this, the squared. Are they able to remember the formula? Let's see. Let's see. Let's get to see. Variance of delta. What do we have there? Hii siwezi dia formula. Hii ni rahisi sana. Hii si mimi najua itakuja ikuwe I'm subtracting between the two returns of the two normally. So we have here the actual returns of the minus actual returns of the. And these must be done what here, somebody? Because you see this is square. Times what here, somebody? And then what do I do at the end of the day? We sum. It's as easy as that. As easy as that. So come and organize your RD. Already you have your returns. Returns of R, we have 6, 7, minus 3.5, 14. Minus. Do you remember expected returns of D? Oh, you wamesahau. Haki ndio hii hapa juu ni 6.275. 6.275. 6.275. 6.275. So then you come here and they get to square them. You are following the formula. You square them. Then you say times the probabilities. Are you able to see our common probabilities? They are here. 0.2, 0.25. 0.25 again. Then lastly, we have what here? 0.3. So everybody must pick their calculators. Put on your best shoes. Should have said dancing shoes, eh? Yeah, don't wait for our numbers. Everybody is punching their calculators. So you say open bracket, 6 minus 6.275, you close, you square. Whatever answer you get, you say times 0.2. Whatever answer you get, you say times 0.2. Thank you so much, Patricia. You're doing a very, very good job. But everybody should pick up their calculator. Everybody shall pick up their calculator, and everybody shall give me their answers, whether they are right or wrong. Whether they are right or wrong, everybody shall give me their answers. The first one. .0.015 from a brother here. 0.015. 0.01. Oh, the next one is 0.21. 41. But can we then be consistent? If we decide to do 3 decimal places, let's be consistent. 0.4. Second one is supposed to be. Ooh, my brother, did you forget to square or something? Please start by saying bracket 7 minus 6.275. You square times 0.25, and then give me an answer as confidently as the brother gave me the answer, even if it was wrong. 131. Yeah. Go to the third one, and you have to be very, very careful here. Pick up your calculator. Minus 3.5 minus 6.275. You close brackets. Whatever you get, you square times 0.25. What are we able to get, ladies and gentlemen? 23.888. Thank you so much. The last one, is there somebody who could be having the last figure? I like the cooperation between the online students and the physical students. We are doing right. A very nice job there. So they're telling me it is 2017, eh? Huh? 903. So from there, what do we do? Yeah, we sum because there is this summation sigma here. So come and sum. And whatever you're giving us here will be the variance. We call it variance. So it will be variance of del R. Variance of del R. Even when you square, you can never get a negative answer. So mnasema inakuja 31, 41, eh? 41 point. So then having gotten the variance of B, what do you think will be the next thing we should do? We get standard? Allah. In the weight formula, there is no standard. It's variance or variance. Unless you simply want to get for the sake of scaring the examiner. So do you want to scare the examiner here? No. To devote their time here. No. You know, for AFM, you'll have a lot of time. AFM, the kind of questions they bring, you'll have a lot of time in an exam. Eh? Yeah, so you should never. It's AFR where you'll have time constraint, not AFM. So go ahead and they give me variance of what here, somebody. You know, we have delta and then we have alpha, isn't it? Variance of alpha. Shall I keep quiet and expect you to do this very well? Let's see. Start by writing the formula, preferably without making any reference. Preferably without making any reference. Preferably without making any reference. So if I'm the one doing this, first I'll write the formula standard deviation A squared. A standard deviation of A's returns. And now for A returns, you've got two of them. We have the actual ones, which are normally different, and then we have expected. So we have returns of A minus expected returns of A. So I want this to be squared. So even this must be squared times probability. And then you sum. All right. So then we move forward and do the substitutions here. Fortunately, we have the returns of alpha. So returns of alpha, I can see we have 8, 5, 14, minus 1. Minus. Expected returns of A. Sasa atualipata wataka kuniongelesha. Si mita make reference to 0 point. Aki uongo. Expected returns of A. Aki ni 6 points. And the expected returns wanga I change. It remains the same. And the probabilities will be the same. 0.2, 0.25. And then lastly, we have 0.3. So open brackets, you say 8 minus 6.05, you square, whatever answer you get, you say times 0 point. Where the very first one gave you what figure? Exams are nil, no. The first one is 7.0.761, 276, isn't it? We shall be very consistent with our decimal places. The third one. 14. 15.80, eh? Ya mwisho kabisa. 22. 14.910. 111. The one who got something different here, please be careful with the negative. You must say open brackets -1 minus this, close. You square. And then whatever answer you get, you say times 0.3. And then you say equal. And after having gotten this, we shall come and add everything. 31.749, 749. So whatever you've gotten here is the variance of alpha. Next step, next. What do you think will be the next thing we should calculate? Remember, in the formula of getting the weights, we have variances and the covariance. So go ahead and calculate in the next step. Give us the covariance between the two securities. That is D and who? D and A. The question is, do we have any student who is able to remember the formula without looking at their notes? Covariance, you think so? Can I give you my book you write here? Quick. Covariance between D and iko maneno iko maneno. Thank you so much. Don't say A and B. Elizabeth, you have tried, but don't say A and B. Remember, we have delta and alpha. Delta is D, and then alpha is A. I hope you are able to see that. Covariance is the one of two wives, isn't it? Two of them. For example, can read hapo. Moja, ukitaka kwenda mbinguni, moja. Ukitaka mashida wawi, maximum, isn't it? So covariance between D and A. So this formula is very easy. You take the deviation of A times deviation of B times probability. And deviation of A, nimeweka vibaya. Ngoja kidogo. Sasa utakuta kama mimi kweli. Makosa. It is D. We start with this, isn't it? Deviation of D times deviation of what yana somebody? A. So deviation of D is very easy. Difference between two returns. We have RD minus ERD. All right. And then deviation of A. Deviation of A is RA minus expected return of A. And then I multiply this with probability. And then at the end of the day, we shall do what here? We shall sum. It looks a crazy big formula, but useless. And you're going to remember it very easily. And you're going to remember this very easily. Yeah, deviations times probabilities. So remember, you can't get covariance of three of them. No, it's two at a time, two at a time. So now I would want you to do a population of these, do a working to enable us get the covariances. Now you're a great student. Do a working for this. 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 Abracadabra, what do we have there? So long as you are able to see, ladies and gentlemen, the returns of dog. Are you able to see the returns of dog? So returns of dog were here. Hata wataka kuniongelesha. 6. 6. Ya kwanza ni 6. Minus 1. Let me get my past papers. You are not helpful. Let me get it. The first one is 6. Second one is 7. 4. Thank you so much. The third one, or 7. Let me just start again. So 6, 7. 14. Minus, minus, minus. Are you able to remember our expected return we got up there? Report ngapi? And do you remember that expected returns don't keep on dancing? They remain the same. Please just give me the returns of A before muendelee na kazi yenu. Yeah. 8, 5, 14. Okay. Minus, 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 minus. Expected returns of A. 6.05, 6.05, 6.05, 6.05. And then now I have the probabilities of 0.2, 0.25, 0.25. For lack of space, I'll write my answer here. For lack of space, this is where I'm going to write my answers. So I'm looking for the first answer, 3 decimal places. 0.107, 3 decimal places. Remember, how do we do this, ladies and gentlemen? You will say here, like the second one, open bracket, 7 minus 6.275, close, times open bracket, 5 minus 6.05, close, times 0.25. What figure are we able to get here? Yes. Minus 0.1. Wazi. Sasa kuja vizuri. Minus 0. How about the third one? 19.428. The last one. Were you able to give us the summation of the 4 numbers? Summation of the 4 numbers. Thank you so much, the online students. Today you are really doing a great job. Thank you so much. And that is why I'm inviting you to my classes, because you guys are nice. Minus 36.06. Yeah, remember, we must be very, very consistent. Once you choose to work with 3 decimal places, we shall work with 3 decimal places consistently throughout. So I think now we are okay. Now we should be able to apply the weight formula. Let me see how you're going to write that formula. Let me see. Let me see how you are going to write that formula. Let me see how you shall write the formula. Let me see whether they will remember the formula. So tutasema weight of who? Weight of A. Unaanza na A na ya kwanza ni D, ama unataka weight of D, isn't it? Should be equal to the variance of the other one, isn't it? Variance of A minus DA. And then you come and add variance of A plus variance of the minus. Now there are 2 of them. Why it's covariance DA. And you see, you can start with any, yeah? You can start with A or D. Doesn't harm anybody. Now you guys have everything. Try your very best to substitute. Try your very best to substitute, and then we get to see what answer shall you get. What answer shall you get? Try to substitute, and then we want to see what answers shall we get all over. I'm seeing so many students who are not writing anything. Do we have variance of A? Hebu kumbusha mwalimu, variance of A ilikuwa ngapi? 31.749, isn't it? Minus twice covariance DA. Do you remember the figure of covariance DA? Si ilikuwa ni hii? Oh yeah. Oh yeah, niko peke yangu. Covariance of DA, it's minus 36. minus 36.063 like that. All over variance of A, which is 31.749, plus variance of dog, which you got up there. There's something wrong, eh? There is something wrong. Which one is that? Yeah. Look at me now. What is the time? I'm tired now, but we shall overcome. 2 iwezi kuwa juu. Asante sana. You guys are nice. Do you know why I'm putting this covariance in brackets? Because of that negative, eh? I don't want to confuse that negative here. So 31.749. Do we have the variance of dog? Ilikuwa inakuja ngapi variance of dog? 41.937 minus now twice the covariance that we got here as that. I pull it up, right? Or formula. All right. All right. And I'm being given an answer here. Pauline, anasema weight of dog is 0.47. Weight of dog is 0.47. Vitu vimeanguka sana leo, which reminds me that these exams are quite close. You know, when we are doing invigilation for custom exam, especially people who are a bit advanced in age, like 40, 35 there, unampatia karatasi ya AFM. Stika ni harufu ya karatasi ile. Inaanza na makalamu zinaanguka zote chini. I'm very humble na mwokotea zote nampatia. Ukimwokotea calculator chini, kidogo unaweza kuona ameweza kutoa ja. Sasa muita nje ya class, naanza kumcancel. Namuuliza kwani, is it a must that you have to pass? Is it a must? Is there anything which is a must in this world? Huh? That you guys are still young. I thought, mmepitia maisha. Hamjapitia maisha bado. Hakuna kitu ambacho ni which should make you sweat. No. It's an exam. If I pass, well and good. If I fail, so what? See, life itaendelea. You've given it your best. Because the students who tend to really put that math thing, they tend to sweat a lot in their exam. Mimi nimeona maajabu. Paka msichana analia kwa mtihani, amepaka makeup inapotea. Mimi nimeona maajabu. Ukiona maajabu sana. Exam za kasi na sio mchezo. So ukienda kwa exam as a lady, usiende na very advanced makeups, no. Usiende na high heel shoe, because wengine nimeona amebeba high heel shoe, amebeba anatembea. So nimeona mengi. So hii kitu hii hakuna kitu kama math. You're studying, you're giving it your best. Key exam you give it your best. If you pass, well and good. If you fail, so what? So come here, 31.749 plus 36.063 all over. This will be 31.74. I mean, you can give me the numerator. Let me just take a shortcut. Are you able to give me the numerator total? 78 point flat, eh? All over. How about the denominator total? 145.812, like that. 145 point. You figure any warm? The numerator. Brother, we figure hapa. You know kuna kama ina hapa. Because itakuwa 67. Ole, itakuwa 67. So hii itakuwa 67 kwanza. The first one is 67.812. All over the denominator total, which is 145.812. 812. So when you divide, what are you able to get here? 0.465. So then we have been able to get the way. Come and give me a summary here, which will be very, very important. So in this summary, you are giving me weight of D, which is 0.465, and then you give me weight of what here? A. What do you think of the weight of A? The two weights must add up to, then the weight of A automatically will be 1 minus 0.465, which will end up giving me 0.what here, somebody? 535. So Delta Limited, 46.5. Alpha Limited Invest what there? 3.5. AFM, meanwhile, you are the thing and practice, and you simply do and get to master the question that we do in class. If you can go and tonight, for example, master what you've done in class, you become a specialist. And then, of course, there's somebody who is asking a very good question there. Are these things applicable in real life? Yes, because number one, you need the skills to pass an exam. Is that not real life? That's number one. And then number two, especially for those of you who will be doing CIFA later, you'll be able to see, ladies and gentlemen, that this is really very applicable. So we answered the question really. You can see Roman 2 of the same. They want us to give them the amounts to be invested. To be invested in each security. So do we have the total amount in the question? How much do we have there? Are you able to distribute this? Yes. So you can talk of delta. You can talk of alpha. So delta is what percentage there? 0.6. And then alpha was 0.5. So times 2 million. Times 2 million. So the first one is what here? 10.7. For alpha, 10.7. Delta, 11. Oh, it cannot be 11. So 930,000. Very good. So I believe if we stop there, ladies and gentlemen, we'll not have broken anybody's bone. Again, we should not study like the world is coming to an end. No, there is life after this. Thank you so much. Bye-bye. See you tomorrow for, not tomorrow, Advanced Management Accounting will be on Saturday. Revision for tomorrow. But you see, tomorrow 1 p.m. is for Muslims. Not unless, what time do you finish on Friday praying? Is it like the whole afternoon? Around 2. So 2 we cannot do. Is it 1:30? The prayer. So then you can meet for 30 minutes. Now the only issue will be, we'll have to study from the mosque. You don't have to study from the mosque. Is it okay? You can get, is it okay? From, no. Then what we could do, why don't we agree that our revision for AFM lunch hour will be on Tuesdays and Wednesdays? Lunch hour. Lunch ni ngumu, unafanya kazi ngumu watu. You have interns to help you guys. Employ interns to help you. Eh? Well. They're very mean, eh? Okay. And with low we shall overcome. Lakini sasa hata mkisema hivyo, we still need those extra times for revision. We need them, like 30 minutes every, like twice lunch hour. Yes. I share the link. Maybe you're not in the group. Really? I normally share the link. How comes then you should be liaising with me? You confirm it, eh? Are you sure we are in the same groups, really? And you've never seen any link there? No, this week you've only had it once, Tuesday. Only once, yes. only once, but we should be able to discuss, like, maybe it's once a week. We need to revise. For example, like if I get an extra hour, I will now finish this portfolio, like revision. When we meet next, we go to the next topic. Yeah, so let's discuss that on WhatsApp. Thank you, bye. The online students, are you able to follow the way I'm teaching this thing? The online students, are you happy with what we are doing here live? Are you able to follow this from home? Are you able to follow this from home? Yeah, thank you so much. Great. We are overcoming. Great. Great. Thank you so much. Yeah. Bye-bye. Bye. Yeah, thank you so much. We shall overcome.